All right, we'll give everyone a second to get in the room as we just launched. All right. All right, good morning, everyone, and welcome to our Meridian Market Update webinar. We really appreciate all of you guys being with us this year and really hope that you enjoyed a festive and very much healthy holiday season. I'm Brian Conlon. I will be your guide and host for this webinar today. And we really appreciate seeing you guys. So today we're going to be talking about and sharing our thoughts about the single family residential market, both nationally and more locally in Memphis as we continue to move through the pandemic. On our panel today, we have first and foremost our co-founder Kevin Conlon, who will be discussing the overall state of the single family residential market. We have our president, Kent Kuykendall, who's going to be providing an overview of Memphis in particular, but also kind of a boots on the ground overview of how things are trending in that particular area and with all the homes we manage. Yours truly will be talking about the specific 2022 opportunities that we have coming down the pike. And then Wendy DeBay, our client relationship manager, will share a couple of announcements and walk everyone through the Q&A portion of our webinar today. So as we move through the agenda, you'll notice in Zoom, and we're probably all quasi-Zoom experts by now, but there's a chat box and a Q&A section that allows you as an audience member to type in your questions in real time. If you have any question at any point, please feel free to use those chat boxes or the Q&A box to put that information in. We will be monitoring the Q&A functionality as we go through. Sometimes we'll answer the questions in real time. Other times we may wait till the very end, just depending on what question is asked and when. But rest assured, we will come back and make sure we answer all the questions by the end of the webinar. A recording of this webinar will be added to our YouTube page and on our website, probably within about the next week. So if there's anything you missed or want to hear again, you will have that opportunity. So without further ado, I will hand it off to the co-founder, Kevin Conlon, to provide a build-to-rent market investment outlook.
Okay, well, good morning, everyone. And I know we really appreciate you being here. I'm going to spend a little time, just kind of giving the state of the union in the real estate business as we see it. And we'll start by taking a look back at 2021 and then look ahead at 2022 to see if we can make sense of everything that's been happening. So 2021, for real estate is, I think everyone knows, was a really good year. A lot of records got set. Nationally, we saw real estate, residential real estate go up 18%. Memphis is pretty close to that at 16%. And rents and occupancy hit all-time highs as well. Nationally, rents went up about 4.5%. In Memphis, it was slightly stronger than that at 5.5%. And economic growth in the country was pretty good in 2021. So the S&P 500, the stock market was up 27%. And one of the things that's significant about that is that generated a lot of wealth that can be invested. And a lot of that, a lot of the gains in the stock market are in fact being channeled into real estate. We saw unemployment continue to fall during the year, and now the unemployment level nationally is at about 4.2%, which is just about where it was before COVID hit. So, yeah, good year. But then, you read the news and you wonder, well, geez, is the bloom off the rose? I mean, do we have some storm clouds forming here? For example, you keep reading in the news that there's a lack of inventory of homes, and builders are straining to keep up with demand. And we saw inflation, rear its ugly head this last year, particularly, later in the year. And then we hear that the Federal Reserve plans to raised the federal funds rate 3 times in 2022, and they've already started tapering their bond purchases and accelerating when they're going to stop, which is going to cause interest rates in the end to go up. We've also seen continued capitalization rate compression. Now, cap rates, for those who may not be familiar with them, we're just taking the net operating income that a property produces, and we're dividing it by its purchase price or value. So when a cap rate falls, it means it's not cash flowing quite as well. And if rents and net operating income rise or fall at the same pace as home prices, there's no change in the cap rate. So usually when you see this cap rate compression, it means that home values are rising faster than net operating income. And that's what you see in this graph here. This is a graph that looks back about 35 years. And you can kind of see that starting around 2012, cap rates really began compressing. And that's not necessarily a bad thing if you own real estate already, but the returns just aren't quite as juicy in a environment of compressing cap rates. And we're seeing COVID's been like a pesky fly. It just doesn't seem to go away. And we're still in the thick of fighting this thing, and it's had quite an impact on businesses. So it makes you wonder, well, gee, are we headed for trouble? Next slide. If we take a closer look at this, with respect to this, inventory problem, I'd have to say that the builders are really managing the problem. Okay, they're having trouble with labor, either skilled, finding skilled labor, or people are getting sick with COVID or something, and that's created some ripples, and also the suppliers of materials have had their problems. But as a builder like we are, it's just a problem we have to manage, and we do, and it just seems every week it's something different. But the good news is we and the other builders are working through it, but it certainly isn't easy. Inflation, which was really bad in fact, it's bad right at this moment. It's according to Fannie Mae, they're projecting the inflation rate a year from now will be about half of what it is today, falling to about 3.8% by the end of the year. Another thing we observe about inflation is wages, have taken a pretty steep rise, and one of the ways that affects real estate is, with rents going up as much as they have been, it's been really good to know that a lot of the people who are renting, have the capacity to absorb those rent increases because their wages went up. So that's really important to remember. And while the Fed has said, yeah, we're raising rates 3 times in 2022, that's the federal funds rate. The mortgage rates, according to Fannie Mae, aren't going to move very much. They'll go up for sure, but they'll rise about somewhere between 0.25% to 0.3% in 2022. Now, there are other sources that indicate that they'll rise a little bit more than that. The source I'm quoting here is Fannie Mae, which is the biggest mortgage originator in the country. So even though interest rates are increasing, it's not going to have a dramatic effect on the mortgage market. You know, it'll affect it for sure, but not too dramatically. Another thing I expect that we're going to be seeing is that rent increases are going to start to keep pace with or exceed home price appreciation at some point. When that happens, that cap rate compression that we are talking about will flatten out, which, you know, is, you know, in the long run, a healthy thing. And as far as COVID goes, you know, as a nation, we just seem to have figured out how to live with it. It's not easy, but we've managed to muddle through with it, and you know, commerce continues, even though you know, we're still having to fight this thing. So we've been adapting. Okay, yeah, go ahead. One of the big fundamentals to always remember, you know, when you're considering, you know, gee, will the bloom come off the rose for single family, is, you know, you take a look at this chart here. You know, the US underbuilt homes for years, and right now, as we speak, we're short about 5.25 million homes over what we should have. In 2022, housing starts are only going to be, you know, about 1.2 million. So it's going to take a few years to fill in the hole and make up for that shortfall. So I mean, we're making up for it, but just not at a lightning pace. Which, as an investor, that's good. That means this asset class is going to have legs for several more years. That seems to be where all of the data is pointing. You know, the thing that's frustrating, and one of the reasons why we can't build faster than this, is just all these delays that keep happening in new home construction related to labor shortages and supply chain issues. But we're working through it. Okay, so if we look ahead at 2022, while it's not going to match 2021 in home price appreciation, nationally, they're forecasting home prices to rise 8.8%, and Memphis is in there at about 8%. Now, just a month ago, Memphis, they were forecasting it like 5%, but now, you know, they're a little more, you know, bullish on home price appreciation next year. And rents too are also going up. You know, 4.3% nationally is what's forecast, and in Memphis, it's quite a bit higher than that. It's forecast to go up at 6.5%. So that's even though it's not quite as torrid as 2021, it's still going to be a pretty strong year for real estate, we think. So in a nutshell, 2022 looks good. You know, home prices and rents are going to continue to go up and to the right. And even though interest rates are rising, they're not going to rise that much in the mortgage market. So that is not going to have a huge effect on the housing market. You know, demand, you know, fundamentally remains very strong due to this, you know, large housing shortage and high levels of investable wealth that, you know, that's out there. And a parting thought is that, you know, as we worry about inflation, time and time again, as you look at history, real estate has always been one of the very best hedges against inflation. I mean, if you have a lot of inflation, you know, property values go up, rents go up, and not all asset classes behave that way. So it's one of the reasons why I continue to invest in this space. So with that, I will turn it over to Kent.
Great. Thanks, Kevin. That's a great overall view of the market. And now we're going to take a deeper dive into the Memphis market and some of the key information about our own properties and our investors and what they've experienced and what to expect. As Kevin said, the Omicron COVID environment continues to be challenging. It feels like we deal with a different shortage every week. It's a bit of a whack-a-mole game. And there's shortages and there's rumors of shortages, which create all kinds of ramifications. But in general, we are being able to manage this. We, as mostly a build-to-rent provider, we use fairly standard products, and we're able to standardize things to the point where we're not using custom homes. If anybody who's built a custom home lately, getting custom things is very problematic right now. So we're managing that. We're giving good forecasts to our suppliers to avoid this, but there are hidden gotchas that may get us from time to time that cause delays in the final closing of a house. So just know that for the most part, we're winning that battle, but there are exceptions. We're also seeing on our maintenance side, we're seeing the same labor increases, the same labor challenges, the same operating cost increases that everyone else is seeing. So we didn't increase our service rates and maintenance rates last year through it all, but this year we are going to be increasing those by 10 to 20%. And you'll get more information about that separately. On the rent collections, and by the way, the good news is, as Kevin said, the revenue side of the equation, the rents are more than compensating for that. So we are still in a positive situation overall as we go into 2022. And rent collections continue to be exceedingly strong. We just had our meeting this morning. Our rent collections are up in January over where they were in December, and it seems like we keep getting stronger and stronger in that area, averaging 99.7% collections every month right now. And as far as vacancy rates and vacancy and tenancy, we're going to talk about these in tandem here. The going vacancy rate in the Memphis market, and this is across all classes of properties, from the low end B and C class properties to ours up in the A class properties, which is all we do. You see anywhere from a 6-7% vacancy rate all the way up to a 12% in the really challenged products. We, of course, have stayed very tightly at about a 4% vacancy rate across all of our properties. So that continues to be a strong aspect of our performance. And one of the fun things we've seen over the years now is we've done a really good, as we all know, all things being equal, it's best to keep a good tenant in your property. It saves you the cost of a turn. It saves you the cost of the expense of having a month down of rent, all the things that go into meeting your economics on your properties. Keeping a good tenant in that property is usually beneficial. So we've really focused on that. And we've kept our tenancy renewal rate up above 70% for the last 5 years now. It's actually been up around 72, 73% every year. And what that's doing is that's increasing our average tenancy of our residents over time. A year ago, it was around 32 months. This year, it's 37 months average tenancy. Next year, we expect it to get up close to 40 months and probably hit a terminal value somewhere around 4.5 years. So that renewal rate is really key into protecting your returns and achieving the pro forma results that you're expecting from us. So that's been a positive, continues to be a positive. You can go to the next one, Winnie. Now let's talk about rents. Kevin touched on this, and I want to get just a little bit more granular. This is John Burns' assessment. They obviously don't have the fourth quarter, but this is first, second, and third quarter of last year. And you see an overall, if you go to the far left, in total, this is where we saw pretty strong rent increases in the first half of the year, but then a really strong tick up in the third quarter and in the fourth quarter that hasn't been reported yet, but we know our fourth quarter results. So this has been a very strong trend. And you see, and you got to understand the two differences. You get the renewals where you've got the same tenant in the property, and usually there's caps on how much that rent can be increased in a renewal in leases. And we had those caps up until 6 months ago, and we have gotten away from those caps. But that was always a good tool to give your residents security in renting a property, that your rents couldn't go through the roof. Well, it's still true. You're always going to get less increase on renewals. But what we're seeing in the market and what we're seeing in our space is about halfway through last year, we took the limits off of those renewal rent increases. And on this chart, you see the national averages. Renewals went from about 5% in the first half of the year up to 8%. And new leases, when you lose a tenant and now you have a chance to get your property all the way up to market rate, saw very strong increases across the country. Let's look at our data now. And our leasing continues to be strong. We're getting, just this week, it's peaked up again. There's a little more normal seasonality to what we're doing, but overall leasing has remained strong, which really supports this continued rent growth. And last year we did get a 73% renewal rate, and we had a 4% cap built into our leases up until July last year. And we made the determination that we needed to phase that out given the shift in the market. So we've done that. So we are working with our current residents to get their rents much closer to market rate. But again, in most cases, it still makes sense to keep that tenant in that property and paying a slightly below market rate, but a good step up from where they were. And once we changed that in the second half of the year, we got it close to a 5% increase. And so far this year in January, we're looking at closer to 7% increases on renewals. So that's much higher than the 4% that we would have normally seen. And over time, that will continue to grow. And as Kevin said, rents eventually catch up to home prices. It's just a delayed effect because you've got leases in place and it takes time to get through those leases. But we expect this trend to continue as we work our way through all of our leases. Now, how about new resident leases? Well, this is where we start to see the big increases. And we got on this game pretty early last year, and we saw a 13% rent increase overall in 2021. But by Q3 and Q4 last year, we started to see an average about 16% rent increases. Now that does vary by zip code, right? So you can see anywhere from a 12 to even a 18% increase on one particular property, which is why it's always good to have a portfolio of properties if you can. So you average those out. But we are seeing very strong rent increases on new leases. And we do expect that trend to continue all the way through 2020 as we work through our leases. And we don't expect to drop. Kevin shared John Burns' estimate of rents increasing, another 5 to 8%. We expect to get our leases up to market rent and continue to see 15, maybe an average of 15, 16, 17% increases the rest of the year. So let's talk about appreciation again, just touching on the same numbers that Kevin shared with you. Memphis was at 16%, which is very, very strong. The thing about Memphis is very consistent, in terms of home appreciation. And there's some things that are going to continue to drive that we're going to talk about here in a minute. And that's why we originally put this presentation together. We were looking at 3 to 5% over the next few years. And then John Burns revised as Kevin said, revised their numbers upwards just this last month. And we're going to talk about some of the things that drove that. But at the end of the day, what's driving this home appreciation, and why do we have confidence that it's not going to come right back down, right? That this is actually a step function up, that now we are going to continue to rise at a more gradual pace. And as always, it comes down to supply and demand that we're going to talk about in a minute. But there are supply chain issues that are limiting construction. And so that continues to add to the scarcity. And you guys have all heard about the incredible spike in lumber prices. This little chart here below, you see Mount Everest there in the middle. That was back in May, June of last year, where price per 1,000 board feet went from $400 to $1,700. Well, that increased the price of a home anywhere from $15,000 to $30,000 for a 2,000 square foot home. For bigger homes, obviously much more. Well, against all predictions, those prices came way down in the fall, and no one was really expecting it, but they've gone back up above $1,000. So we're back up in that high range again. So the market has to absorb that. And so far the market has been able to. So that's why we can manage through this. The market is accepting that. And as rents are increasing, it will keep our returns coming through in good shape. But this is an interesting chart because, at the end of the day, limited supply plus affordability leads to upward price pressure. So limited supply is kind of supply and demand wrapped up in one. And this chart shows that the national average, the very bottom bar on that chart, shows the national average months of inventory that are available is only about 2.4. And traditionally that's up around 3, 4, 5. So nationally it's low. You look up in Memphis where the red arrow is, it's 0.6. You know, there is a great shortage of available properties in the Memphis area. And yet, even with that limited supply, it's still very affordable compared to household incomes, compared to the rest of the country. You know, you look at some of these other countries, this is just a Burns index. That number is roughly household income divided by the cost of housing. There's some other adjusting factors in there. But roughly, to own a house in Memphis, it's about 21% of the household income. That is incredibly affordable compared to the rest of the country. So you add that affordability to the limited supply, and that can't help but continue to derive upward pressure on the price of homes. And that's based on the existing Memphis economy, which is growing at jobs are growing at about a 3.5% clip, almost 4% predicted for this year. The distribution economy that we always talk about took a huge step function up during COVID, and it has been maintained there. So jobs are coming to Memphis, where distribution centers are a one-way trip to their customer because of FedEx being located there. But the other kicker to all this is, and if you missed, we talked about this in our last webinar, but for those of you who didn't see it or may not be aware of it, Ford Motor is making a $6 billion investment just outside of Memphis to build a huge battery factory, which is going to support their Ford F-150 electric Lightning truck. They're building some of these up north, but this is going to be their main plant. And this is going to create anywhere from 15 to 25,000 jobs directly and indirectly, and no doubt spawn more of a manufacturing base of employers in the Memphis area. So this is a huge thing. They supposedly are breaking ground this month just outside of Memphis. It's going to bring a bunch of construction people in to build it to begin with, a lot of renters for sure, and then the workers will follow and the support industries will follow. So we're very excited about this. And if you go to the next map there, this map kind of shows the location of where Blue Oval City is. And the good news is we've got a ton of inventory getting ready to be built within 20 to 30 miles of Blue Oval City. So on top of an already thriving Memphis e-commerce-based, logistics-based economy, now it's getting a huge manufacturing boost. And as everybody knows, these electric vehicles are being incentivized, are being supported, are being legislated into being, where this is a pretty, and everyone, all the car manufacturers are trying to keep up with Tesla and their valuations. So they're putting a lot of pressure on growing their EV vehicle business. So we've got a lot of, this is really good news. And no doubt it will affect the price of houses everywhere else in Memphis as well, as houses in the Northwest sector, Millington, Arlington, Oakland, Somerville, where we've got projects, those will get snapped up, and that'll create pressure in other parts of the community as well. So I know Brian is going to talk now about some of those specific opportunities for next year. So Brian, turn it over to you.
I appreciate it. Thank you, Ken. All right, so to talk a little bit about inventory, first off, I'm excited to share this stuff because we have much more granularity for what the 2022 inventory pipeline queue is really going to look like. And really thank you all for the patience around this. I know there's been a large demand for these particular homes and products, and we have not been able to supply it at the level that we were hoping to. However, we've almost doubled the amount of inventory that we're supplying to investors this year. So we're very, very excited about that. And what you're looking at here is a map of all the areas in which we built new homes in subdivisions across the Memphis MSA over the past 4 or 5 years. So many of you already know this, but I just would like to reiterate it. So we always target areas that have some sort of compelling story to them. Kent just mentioned a great one about, the Blue Oval City coming to, northeastern Memphis is going to be driving a lot of demand in those particular northeastern regions of the Memphis metropolitan area. Where you see a lot of the areas in which we built before and continue to build are kind of in this southern cluster that straddles the Mississippi and Tennessee state line. What we love about that particular area is it's right around the airport, and a lot of logistics related jobs are coming to that area. Amazon, Google service centers, Nike, Williams Sonoma, et cetera, all have fulfillment centers and warehouses that are clustered down here. So the areas we're typically targeting are upscale suburban outskirts. So we don't like to be in the city center. First off, there isn't much land available, but also there's greater volatility as far as sometimes those neighborhoods are great and sometimes they're not so great. And by staying out in the suburbs, you have a more consistent expectation as far as quality of neighborhoods go. So as an investor, we obviously appreciate that. Naturally, we're always targeting quality school systems whenever possible. And another thing that's been very positive for our investors are targeting retired areas. These are residents that typically tend to stay in their home for long periods of time, take great care of the home. These are a lot of folks that used to own their primary residence, but as far as being a lifestyle choice, chose to sell their home and then live as a renter based on the fact that it's still affordable to rent and they don't have to worry about the responsibility of home ownership. So once again, as an investor and owner of these properties, these are great residents to welcome in. So we're going to be talking about 4 specific subdivisions that we've really been highlighting over the 2022 year. Many of these we've talked about before, but now I can really give some granularity as to when these properties are going to be available. So the first one we're going to be talking about here is the Creekwood subdivision, which is down, it's kind of southeast of the Memphis city limits. It's just southeast of Olive Branch and just down the road from them. We originally had about 32 properties available in the subdivision. Right now we're down to about 8. So what you can see here is, gosh, this picture was taken about a year ago. You're right here, you're looking at kind of, if you can see where my cursor is, looking kind of north by northeast right here. All of this area is just covered in homes at this point. So our builders have done a great job of getting this area built up relatively quickly. The thing we really like about this area is it's right next to the elementary, middle, and high school. These are larger lots. The area itself is absolutely beautiful. And the big claim to fame is Amazon opened up a 1 million square foot or so campus down there. I believe it's a fulfillment center. And there's a large influx of jobs in Byhalia, but there hasn't been a lot of housing. So housing demand here for both on the rental side and on the retail side has been quite strong. The next area that we're heavily involved in this year is Rasco Farms, which is in South Haven, Mississippi. Now, this is an area we've been providing product since we first moved into Memphis. The things we like about it is it's right there in the middle of the logistics hub, centrally located, great schools. It's in the DeSoto County public school system. And these ones, we're building out the final phase in partnership actually with D.R. Horton to build out about 13 investor properties, as you can see here. The next subdivision we'll be talking about is Mallard Park, which is in Walls, Mississippi. Now, as of a few years ago, Walls was a very sleepy town. It did not have a large population. However, in 2006, 2007, there was a large investment in the local public school system to the point where some of the top rated schools in all of DeSoto County were here in Walls. But once the real estate market tanked back in 07, 08, all of the building in that area that was expected came to a halt. Now, builders such as ourselves and some other builders are finally building up that area. It's seeing a lot of demand and local interest based on the quality of the schools and the infrastructure that's been put in there. And a lot of the logistics jobs are spilling over into the Walls area. So Walls is very much up and coming, and coupled with that school system and logistics jobs, we do envision this to be a great place for rental products moving forward. The community itself is actually quite pretty. You can see here, these lots highlighted in yellow are part of our first phase of the development. The ones in gray are the second, and all these ones that are not highlighted are part of an existing build out that happened several years back. There's also a community pond back here with a walking trail that grows around. And this is an area that we're going to be selling a collection of homes as to retail buyers in addition to rental properties. I think we have about 60 homes total getting built out in phase one. About 70 to 75% of those are specifically for investors. Next up is Nicole Place subdivision. Now, this is an area we've actually been building in since, gosh, 2014, 2015. It was, in fact, one of the very first areas that we decided to build out. Once again, this is just neighboring or right down the street from Walls. And what Walls is today is what Nicole Place and Horn Lake felt like when we started building there several years back. There wasn't a lot of traffic there, definitely a sleepier town, but a lot of the logistics related jobs that have really been coming in there at exponential rates over the past few years have really bled over into the Horn Lake area, and specifically right around this Nicole Place subdivision. So the population growth has been quite strong there. The schools are continuing to get better as there's a lot more public tax money going into the local school system. And being that it is located right next to a lot of jobs, there's been a lot of demand both on the retail side and on the investor side as far as a demand from local renters that wish to live in this particular area. So you can see here, all of these homes kind of in that gray color have been built out, and the final phase of properties, of which we're going to be building out around half, are highlighted here in yellow. And of the half that we're building out, we're forecasting at least 22 homes for investor properties. All right. So I guess what I didn't cover there or specify is in the presentation, we did show the exact timing of each of these subdivisions. All of those are going to be happening throughout the 2022 area. We're just focusing on different subdivisions during various parts based on kind of how this construction schedule is shaking out. So with that, I will turn it over to Wendy to go over any questions that we've had on the panel. And then we do have a couple of announcements we wish to make before we let you guys go here. So Wendy.
Thanks, Brian. We actually did have a question just come in from Paul. So he's wondering if there are advantages to building or investing in Mississippi rather than Tennessee.
Yeah, so I guess it depends if you, well, Kent, do you want to talk about any differences in building? Then I can talk about it on the investor side.
Yeah, on the building side, it's just a little bit easier to build in down in Mississippi. It's a little more wide open down there, but I think most of the advantages are on the value proposition that Brian can talk about pretty well.
Yeah, typically, and this isn't always true, but more often than not, the property taxes are lower on the Tennessee state side than they are in Mississippi. And the major driving force, I'm just learning how to talk again, that leads to that is the fact that the public school systems in the areas in which we build in Mississippi and primarily DeSoto County have higher quality public school systems, and a greater percentage of the property tax actually gets put into the public school system. DeSoto County takes a lot of pride in their public school system, and as a result, they charge a higher property tax value on the property. So the net effect is that Tennessee overall typically tends to have a little bit better cash flow, but on the Mississippi side, there can tend to be a little bit better appreciation based on the fact that the school system's a little bit better. So what I do, for instance, is I try to have a nice blend between the two areas based on the fact that I like cash flow and I like appreciation. So from a diversification standpoint, I mean, both areas are great. It's just kind of a matter of whatever your preference is as an investor. All right, was there any other questions, Wendy?
Yeah, no other questions right now. So please feel free to put your questions in the Q&A or the chat box if you have one. So as far as announcements go, I just wanted to let everyone know that we've updated our investor handbook, and that's really a guide to your responsibilities as a buyer from us and also a homeowner. And that nicely outlines everything from financing your property to property management, Q&A, just information that we really want you guys to have in hand. So if anybody would like a copy of that, please put your name or an email address in the chat. I'll be happy to get that out to you today. And then for our other announcement, I wanted to actually turn it back over to Kevin Conlon. Oh
yeah, well, no, it's not a big deal, but in 2022, this is the year I'm going to kind of go from, being a full-time guy to more of a part-time guy. So, yeah, I guess as you get older, you start valuing your time a lot more. So, I mean, I'm not retiring. I'm still going to be, involved in the business, but, if you notice my profile is not as high, that's probably the reason why. So I'm taking some time for myself. In building this company, one of the things I wanted to do is just make sure we had a really solid company that could operate without me or my partner Jeff, being in the middle of it, all the time, and we've really achieved that. I mean, you've all gotten to know, Kent and Brian, who've done a terrific job for us, and Wendy's been a great addition. We have a really, really good team right now, and they're very well managed. So, but anyhow, I just wanted to give you a heads up in case you don't see me as often. So that was that.
Thank you, Kevin. And I appreciate you guys adding your emails to the chat. I know, Brian, you wanted to add something.
Yeah, so first off, congratulations, Dad. I'm really excited for the next chapter for you. The other announcement I wanted to make too on the upcoming webinars that I'm pretty excited about is we're going to be bringing in a mortgage broker to talk about a number of additional loan products that have come to market over the past really 12 to 18 months. Now, some of these loan products are actually pretty cool. There's one in particular, an interest-only product that provides, I mean, typically whenever we analyze these investments, we look at it through the lens of a 30-year fixed rate coupon. And with the cap rate compression that my father spoke to earlier, the net effect has been that the cash on cash return is not quite as tasty as it has been in years gone by. However, with some of these new loan products that are coming out, there's actually ways to enhance or beef up your cash flow in a way that actually improves your overall internal rate of return over what you would see at a 30-year fixed coupon rate at current market rates. So I want to bring in this gentleman to talk about these loan products and give investors some insight as to what else is possible outside of kind of the more conventional purchasing process that many of us have been going through in days gone by. So if you're interested in knowing more about those products, that'll be a good thing to tune into and learn about when we meet, which I'm guessing will be in that first Thursday of April upcoming this year. So with that being said, Wendy, I'll turn it back to you for final remarks and Q&A.
I think that's all we have. We've got some nice messages of congratulations here for you, Kevin. And no more questions. So please put your question in the chat if you have one. Otherwise, I think maybe we're ready to wrap up.
All right. Well, once again, like we echoed earlier, thank you guys all for your trust in us, for being here with us. Without you guys, we obviously couldn't do what we do. So we definitely appreciate it. And as always, feel free to reach out to any of us on the panel if you have questions. Otherwise, we will be sending out some investor handbooks, and I know I'll be talking to many of you guys soon. So that being said, Happy New Year, and may you get a great start to your 2022.